Welcome to the show. Bill Baruch from Blue Line Futures in Chicago. Bill, I explained it to you as best I can, is that, without getting too political, I think our energy situation has really caused a lot of this inflation anyway, but that's a whole nother show. But we've got this situation now on our hands where gas is up over 50% year over year. We're 7-year highs in crude oil, and a lot of folks are talking it could go higher. And if something happens with Russia and the Ukraine, that could be the case. Now we're going to embark upon this campaign of interest rate hikes with the Fed. Who knows if they do 25 basis points or 50 basis points, whatever. Could there be a situation where we've got food and fuel? You've seen the commodities today. Look what they've been doing the first day of this month. Could there be a situation where we see all these prices power ahead and kind of negate what the Fed's trying to do as far as cancel out inflation?
Absolutely. Since joining your show a few weeks back for the first time, it's been a big narrative of mine that I've been, talking about here with you is this is a policy error. It's a policy error in Washington. It's a policy error around the world. And, it's stoking inflation. Now, I thought I saw a good tidbit here from Goldman Sachs earlier this morning saying that OPEC Plus could bring on more production than expected over the next few months. And I honestly don't see how they can. This market, crude oil right now specifically, is trading on spare capacity. And simply put, the spare capacity because of underinvestment is not there. And I think that policy is also putting those producers, basically a hand or two tied behind their back, with the policy that's out there. So I think that, yeah, we could very well find ourselves in a time where we get 2 or 3 rate hikes this year and crude oil is still at $100. Right now, even, we have a probability of 61% chance, a 61% chance that we see 5 hikes this year. And crude oil hasn't even batted, an eye at it. It's still holding at $88. So we've seen this go from 0 to 60, if you will, hit the gas on these expectations, and crude's holding.
So let's just take a little bit of a financial tour outside of what we just talked about. I agree with you. This is going to be tough operationally, and maybe that's the case. But the 10-year is not telling me that's the case. And I think that what is telling me that it's going to be a very, very difficult thing to do is the volatility we're seeing in the equity market. Speculators and investors are not sure that the Fed can actually thread that needle. And I think that that's why you see these up and down days like we've been seeing, because one day they think they can and the next day they think they can't. I think it's going to be, it's going to be almost impossible, if you ask me, and I got a lot of experience there, that to see the Fed actually be able to surgically carve out inflation without hurting mom and pop and the rest of the economy.
Well, you made a good point there with the 10-year. It's 10 years holding between 1.7 and 1.9 right now, and kind of just going back and forth over the last week. It's not so much about the 10-year. The 10-year and the 30-year know that the Fed's not going to be able to do 5 hikes this year. That's what's the problem. It's they're holding ground at these lower levels of rates, 1.9 and as a high in the 10-year, but it's the front end of the curve that's actually rising. Yep. Because all these rates are going to be front loaded, and that is something you and I discussed a couple weeks ago. That's a precursor to a recession necessarily. Is that flattening of that yield curve, and it's happening pretty fast. And as these rate hikes are getting priced in, that's where we could really start to see mom and pop, like you said, get hurt.
Yeah, and I've been watching it ever since I started talking about it with you, and that the difference between 2-year rates and 10-year rates that you just mentioned, say around 1.8 for the 10-year, and the 2-year. The 2-year's been catching up on the 10-year rate, and that's called a flattening of that yield curve. And boy, oh boy, investors really hate to see the 2-year overtake that 10-year rate, right? When things get inverted, that really is a big sign, not a yellow flashing sign, that's a red flashing sign of some sort of recession around the corner. And folks, we've been moving that way in those rate markets, and it's quietly really not gotten a lot of headway. Would you think that? I haven't really heard a ton about it on the other shows, have you?
No, people are talking about the flattening, and you have everybody coming out from here and there talking about inversion from time to time. What this really reminds me of, though, is you go look back at 2018 and coming into 2019, that's when the yield curve flattened and the 2 and 10 basically inverted for a very short period of time. We're moving back to levels last seen since coming out of those lows of where the difference between that 2 and 10 were. At that time, though, rates were, I forget exactly where they were, but the Fed had room to start to cut, and they started to ease policy at that point. So they have no room to ease policy here, and that's the real problem. So I think that comes back to the Fed, that it's less about where they see the economy so much right now. So it's less about how it's going to impact crude oil or ag prices. It's more about they need to lift off, and they need to, if they think that they will be lucky to get 3 this year as soon as they can. And if that's it, that's it. But they need power and powder in order to throw at it next year if we do have a real slowdown.
And so I just want to give the viewers and the listeners out there what we're talking about, so they, the red mist doesn't come on over your head, because it's hard to explain. But just know that if that short-term interest rate, that 2-year interest rate, starts to encroach upon the 10-year interest rate, that's called a flattening, where things are getting to be more and more equal. And then if that 2-year interest rate then overtakes that 10-year rate, that's called an inversion. And I'll tell you, the rest of the investing community, right, Bill, they get very nervous when they see the rates start to flatten, because they're worried about an inversion. And an inversion has always been what would happen right before all the recessions that we had, correct?
Correct. Yeah, you said it. That's a great way to put it out there.
So that's as simple as I can say it. And, I like it explained to me like I explain it. So just keep an eye on 2-year interest rates versus the 10-year interest rates, and you'll have an idea about what the rest of the market's been looking at, and you'll have an idea about why we've been so, say, volatile. Now, how many rate hikes can we get in this year, Bill?
I think that the upside would be 3. I mean, they're going to come here in March, and I think they'll follow it up potentially. I wouldn't be surprised if they try and get a second one in, the next meeting, and not even wait until the next quarterly meeting in June. Just to, like I said, they want to get off the ground, and they want to have some powder in case there is a real slowdown. Now, with that said, though, I do think that, looking back to 2018, and a lot of the banks are calling for a 5 hikes and 6 hikes. They get out over their skis. I remember a lot of these banks calling for 4%, 5% 10-year in September of 2018,
right.
And that was the high.
Right.
That was the month that they were calling for that was the high. So
yep.
I think that we're starting to see peak hawkishness right here, right now, and that brings opportunity, because I think that if you're looking at dollar denominated, meaning commodities,
yep.
then I think the dollar tops at the onset of, or at very early stages of a hiking cycle, because it's all front loaded into the expectations.
Okay.
So this could bring a lot of opportunity into the markets.
All right, we're going to hang on that one. That's great stuff. Thank you very much.